contribute to a Roth IRA and I'm not planning to. I just did the math for myself and I'm gonna walk you through it so you can make the decision for yourself. So I finished up my first year working my corporate job and all I've done is max out my 401k. And that's kind of what I was intending on doing just because I do make really close to the limits of a Roth IRA. But I have recently learned about the backdoor methods, so I wanted to do the math to see if I should actually contribute to that or just stick to what I'm doing or do something entirely different. So if you're not familiar with a 401k and a Roth IRA, they are retirement accounts. One is pre-tax, the 401k, and one is post-tax, the Roth IRA. Each of these accounts have their own contribution limit, so 401k maxes out at $22,500 a year, and a Roth IRA maxes out at $6,500. The other option I'm going to be testing is contributing enough to get my employer match, and then just maxing out my Roth IRA after that. Just for kicks and giggles, I also wanted to see what the math would be if I max out both of them in a year. So this is what we're looking at. These are the income limits. This is just what all the math works out to be. And this would be your 5% match from your employer. And for this, I'm just using my salary. I started last year. And my salary base is $130K. The salary itself doesn't make a huge difference just because there's only so much you can contribute to your either account, regardless of how much money you make. The only reason that's in there is for the employer match. It's 5% of your income that they will match if you contribute 5% of your income to your retirement account. So it's free money. So definitely do that if you can. So the biggest point of contention between these two accounts and why people are so firmly in one camp or the other is because one is pre-tax and one is post-tax. So what pre-tax means is you can deduct any contributions to your 401k and not pay taxes on them. So say you make $100,000 and you contribute $20,000 to your 401k, then you only are taxed on $80,000 of income for that year. Versus post-tax, you would pay taxes on that. Then from your post-tax income, you would then contribute to your account and take all of that money out post-tax. So we're looking at this here. Don't come for me for my tax math, but this is like your active tax rate. So like I did the math in a calculator. I just didn't want to do it in Google Sheets. So this is how much taxes you would pay. So you can see your post-tax income would be like take home would be 89, 100, 94, 82. So all kind of in the same ballpark. This is the growth portion. So say we all start at $0. And so we start doing our monthly investments, which comes from over here, this number. Divided by 12 because that's how many months are in a year, and then how many years it has to compound, and then the growth rate for the S&P is about 8% year over year. So just for some quick maths, we're looking at compound interest here. So if you're contributing a certain amount every single month, essentially it just says your money is growing and the money that you're adding is also growing. So the next thing to account for is when you're actually retired. So when you're 65 or whenever you want to retire, how much money do you have in those accounts and do you have to pay taxes on it? So for your Roth account, all of that money is tax-free. For your 401k, you will pay taxes at your income level at that point. So if you're no longer making any money from your corporate job because you are retired, you will pay the amount of taxes of income you take out of your retirement account. So if you take out $100,000 of your retirement account, you will pay taxes as if you made $100,000. Okay, so this is the next thing that kind of threw me off. Anytime I see a TikTok that's like $3 million tax-free, but you're not taking it all out at once. You need to spend that $3 million over the course of potentially 30 years. So let's look at how much income you would take as like a salary, a retirement salary from your investment account year over year and how that would look. Here we have years till 100 because I guess that's when life expires. So if you retire when you're 65, you would have 35 years left. So if you just divide all of these numbers by 35 years, which is not entirely accurate, but who cares? Then you would end up with this amount, $300,000 versus $70,000 that you can take out a year and then other combinations as well. So one quick caveat, obviously you're not going to take all of your money out at once. So the money that's left in the account will continue to grow, but we're just going to not account for that because that was too annoying. And my point is made regardless. So then here we account for our post-retirement taxes. So if this was your income, $300,000, you're going to pay an active tax rate of about 25%. Here, this is your Roth, you're paying $0, and then this combination. And anyways, so this is your post-tax annual income that you actually get to take home every single year. So if you just max out your 401k from the time you start your corporate job at 22 or whatever, this is like the money that actually enters your bank account versus almost $70,000 just using your Roth. Yes, you can argue that you've already paid your expenses, your bills are paid off. I would rather take the $200,000 than $70,000. So this is enough for me. I am going to continue with my strategy of only investing into my 401k and put investments towards like my personal investments in my brokerage account. Like, the other thing I will say is, if you can't contribute the maximum amount, you should do this math for yourself with how much you can contribute, because there may very well be a difference in the amount that, like, if you can only contribute $6,500 a year, period, definitely do the Roth. Do the math for yourself. I just wanted to walk you guys through how I did it. Leave any comments below about questions and follow me for more content like this. Bye.